Did you start your business to become financially free, but despite the fact that you're making more money than ever, you still feel broke and financially anxious all the time? Your revenue has exploded, but your net worth, it's barely budged. And the reality is this is because you were being taught wrong. Making money is not the same as managing money. And you're really good at making money, but you've never really been taught what to do with that money and how to make that money work for you. Most of the people you see online who are bragging about making $1 million aren't actually millionaires. Making $1 million means you have $1 million in revenue coming into your business. Being a millionaire means you actually were responsible with the money you made. You saved and invested, and now you have $1 million net worth, which is your assets minus your liabilities equals $1 million and plus. That makes you a millionaire. And my main goal with this channel is to make more millennial millionaires out there. Not flashy, I make $1 million on Instagram, but actual balance sheet millionaires where you have money in your investment accounts and you can retire and enjoy financial freedom whenever that may be. Because the reality is if you want to build your wealth, you're going to need to invest outside of your business. As a coach, a creator, a consultant, you're building a cash flowing business. And the best way to build wealth from that is to invest it outside of the business. But this doesn't need to be all or nothing. And that's one of the biggest mistakes I see online is that gurus tell you need to reinvest all this into your business because it's going to grow at a rate better than the stock market. And they may not be wrong. I am not refuting that. I do believe you have to siphon off a little bit of that cash flow and invest it into something passive that can work for you while you're not paying attention to it. And then you can also reinvest back into the business because the reality is if you can grow the profit from your business, that means that's more money you're actually able to save and invest into the stock market while growing your wealth. So it's a win-win if you're able to do both. I'm Justin Green, a certified financial planner, and I help online business owners in their 30s and 40s who want to take the revenue and profit they're making in the business and turn it into real wealth by investing into the stock market and taking care of their family and their futures. And in this deep dive, I'm going to take you through an exact example using a sample client of how I help them figure out what their goals are, figure out how much they can save and invest, where to save and invest this money, and show you how long it actually takes to become a millionaire. Because one of the biggest misconceptions is that becoming a millionaire happens overnight and that there's more millionaires than you believe out there on the internet. But there's not. It takes hard work, consistent saving and investing, and I'll show you exactly how much you need to save to become a millionaire, when, and how to accelerate it. So let's dive straight into this. And if you're an online business owner in your 30s and 40s making over $20,000 a month and you want help creating your own financial plan and figuring out how to save and invest for your future, go ahead, schedule a call with me using the link in the description. Let's dive in. All right, so this is the exact confidential questionnaire that I send all new clients to get a better understanding of their financial situation, but also understand their mindset, their vision, and what's motivating them to be successful. So the very first question I ask is, what does financial success look like to you? Now, this is different for everyone, but I'll be honest with you, the one common theme that comes through every single response is the word freedom. The freedom to travel, the freedom to spend freely, the freedom to put my children through education, the freedom to retire when I want. Freedom is the number one common theme through all these questionnaires that I've sent to clients and prospects. Now for this sample client, we're going to call her Alicia. She's an online fitness coach. She's 33 years old. And I asked her, what does financial success look like to her? And this is exactly what she said. Freedom to not worry about my financial future and know I'm doing the right things with my money. But that's not enough. I want to go a little bit deeper. So I say, what motivates you to be financially successful? So not only do I get a picture of what that looks like, but why is that so important? And what she said was, I grew up without much money. As I plan to have a family of my own in the near future, I want to make sure my kids are set up for the future. That's huge. No, now I know in the back of my mind, there's a family coming down the road. There's not one yet, but it's coming. And it's a big driver of how she's motivated in saving and investing. And then the final question I ask here, and these three questions for her vision in the future, is if money weren't a factor, what's your ideal day look like? She says, I love what I do. I'd continue coaching, but also be able to work less and stay at home with my future children, maybe travel more. So this tells me flexibility is going to be key in this plan. And that's honestly another big theme I see with entrepreneurs, solopreneurs, business owners. They kind of started a business for flexibility and freedom, right? And so this tends to come through. But now I know with everything I'm helping her with, we're going to think about, okay, future flexibility, right? So we probably don't want this all tied up in retirement accounts. We're going to think about children. She doesn't have them yet, but they are coming in the future. So we'll think about that and how she could provide for their educations. And so let's dive into the program I use to create her client profile and look at how she's actually doing right now. Okay, so I'm going to show you here. We've got Alicia. Like I said, she's 33. She's technically single. She's not married, but she's in a long-term relationship. She's pretty hopeful that's going to change soon, and she's got kids in her near future. That's conversations her and her partner have had. And so while we're not planning with her and her partner yet, we are thinking about those potentials coming down the road soon. The number one thing I want to help her with and show you in this video is how much she needs to be saving and investing. So the first thing I asked her is, well, how much do you have available to save and invest each month? That's the starting point. So if we look here, she's currently making $250,000 in profit. She is an LLC business owner, not being taxed as an S Corp at this moment. Her expenses here are, she's spending around $7,000 a month after tax. So that $7,000 is actually in addition to $3,000 a month that we're modeling for her rent. So she's actually spending closer to about $10,000 a month after tax. Now, Alicia, she's currently not saving and investing at all. She's got a decent amount of cash in the bank, but she hasn't started saving and investing, and that's why she reached out, because she knows she needs to. So she's got about $2,000 a month, she says, in cash flow that she can start investing. So what I've done is I've set up these two accounts that we're going to take a look at. We got the solo 401k, and we've got the flex fund. She's currently putting $0 into each of them, but we're going to walk through what she should be putting into those and how that's going to grow over time. So what I'm going to do is I'm going to take her over to this retirement tab under the analysis tab. What I'm taking a look at here is a simulation where they run 1,000 different scenarios, good and bad, to see like what's your probability of success under this retirement scenario. Now she's 33 years old. We're really not diving too deep into retirement planning, but the cash flow feature on this page is what I'm really looking to dive into. So when we come down here under the scenario, we've got her saving nothing. So I want to take a look at like, okay, what if we took the $2,000 that she's able to save each month and we put it into a solo 401k? Now, for simplicity's sake, she can max out the employee side of a solo 401k at $23,500, and then we're going to put the other $500 in here. This is just a brokerage account that we call her flex fund. Now, she could put more in the solo 401k, but when we dive into the recommendations, remember flexibility is key. So I don't want to tie all of that money up in a retirement account. So we're just going to max it out on the employee side. But do know that a solo 401k is actually one of the best self-employment retirement accounts because it gives you the capability to also contribute as the employer. So you can max out these accounts up to around $70,000. Depending on the year, the limits change each and every year. So in 2025, you can max it out around $70,000, depending on how much you qualify. So there is a calculation based on how much money you make. But she can contribute $23,500 as an employee, and we're not even going to worry about the employer side for her situation. So this would be $2,000 a month, $24,000 a year that she's saving and investing. So I want to show you what that would look like. Okay, so we're looking here at the cash flow year by year scenario. If she's investing $24,000, it's assuming a portfolio return here, which is a very aggressive portfolio, about 90% stock, 10% fixed income, because she's so young and she has such a long future ahead of her, and she's comfortable with taking that risk. Honestly, most of my clients, because they're in their early 30s and 40s, are comfortable taking a lot of risk in the markets, and so they're usually in a pretty aggressive 90% stock portfolio. But this does depend on your risk capacity and your risk tolerance. What we're looking at here is she's starting at zero, she's saving $24,000, and then it's ending at $24,000. Then you'll start to see the portfolio returns, because this is assuming she's saving it towards the end of the year. There's nothing there. But as we kind of move through here, you'll see that it actually takes her until she's 52 when that beginning balance. So at the end of her being 51 years old, she finally crosses $1 million. So she's 33 right now. That's like 18 years. That's a pretty long time. She's making a good amount of money in the business. $250,000 in profit is really good. She's saving a pretty good portion of that. 24,000 is a little under 10%. So it's not, the recommended 20%, but she's starting out pretty well, and it's still going to take her 18 years to be a millionaire with her investable assets. I'm excluding the a home that she may buy in the future, etc. We're just looking at liquid net worth, which means her investable assets. So what if we invested more? And I want to show you that because one thing in this scenario is that she's not utilizing the S Corp taxation, which her situation, it makes a lot of sense. A lot of people will elect this too soon, but if you're over about $70,000 in profit, you should probably start thinking about it. She's at $250,000 in profit. She needs to make that change because it's going to save her significantly. So if you'll notice in the proposed plan, I actually changed this to $75,000 as an S Corp salary, $175,000. I'm not going to dive too deep into S Corp here, but if you want to learn more about that, just leave a comment and let me know. We can dive deeper into that in another video. But what this allows me to do is save her taxes. And what that does is frees up cash flow so we can bump that savings up to $3,000. So let's take a look. So this, we're going to bump up to $12,500. That's a total of $36,000 a year. And one thing I want to re-emphasize, this right here may not be the best mathematical option. Maxing out the solo 401k at a higher rate would lower her tax bill right now, and then she would pay taxes when she withdraws that money. But the reason that we're not doing the full amount here is because she does want flexibility in the future to stay at home with the kids or work less or whatever that might be. And so we also want to build up this flex fund, which is just a taxable brokerage account. We call it the flex fund. It just gives it a name. It makes it more exciting, something you get more excited to add money to. But the reality is this is a taxable brokerage account. And what that does is it lowers the tax hit in the future, and there's no penalties if you withdraw money because you're only going to be taxed on your gains in this account. So that is why we are balancing this. But I just want to let you know that might not be for everyone. This makes sense for her and her goals. Okay, so if we come over here and we're looking at her invested assets, now we take a look, and by 47, she's going to hit that $1 million mark. So this is going to take her about 15 years to hit her first $1 million. So we have brought that down a couple years, but it still takes quite a while. Most people think they're going to be a millionaire in a couple years. That's probably not the reality for a majority of millennials. Becoming a millionaire is not as easy as they make it seem, because you can even get really good at making money and make millions of dollars, but if you're really good at spending it, then you're not actually becoming a millionaire. Now, one thing I want to point out here is, all right, car alarm just went off. We're good now. All right, so one thing I want to point out here is it takes about 15 years to hit that first million, but let's take a look at how long it takes to hit that second million. So when we're looking here, it takes about 6 years to go from 1 million to 2 million. So 15 years to get to the first million, which is the hardest, and then only 6 years after that to get to the second million. What about the third million? Another 4 years, another 4 years to get to that third million. And that'll just keep coming down, as you can see. So if we scroll all the way down here, assuming she were to want to retire at 65, which is the traditional age, but let's be honest, as an entrepreneur, business owner, things are going to change. That might not play out. So starting year 65, she would be a little bit under 6 million, but she would have almost $6 million in investable assets. And now I do just kind of want to highlight, one, I can't guarantee any of this. Two, the only thing I can probably guarantee is that it won't be exactly like this. This assumes a level of return that stays steady throughout consistently, but the reality is it's going to go up and down. There could be a very bad period of returns. There could be a high period of returns. So this is going to fluctuate. Number two, it assumes that she's able to continue saving at this rate for the next 30, 40 years. That may not happen once she has children. Her savings might come down a little bit. So these are different scenarios that you update live as the situation's going on. I'm using the data we have now, but just know, this is pretty far out. I mean, that's 25 Yeah, that's almost like 20, 25 years. So just know things will change. I don't want you to get tied to these numbers. Just want to show you how we model and project. Now, one way to combat this is we run a Monte Carlo simulation. And what that does, it runs 1,000 different scenarios, good and bad, based on the data we've inputted here. And it can tell us like, okay, what's the percentage that this all works out for you? And you're able to retire at 65, assuming some spending figures. Okay, so here what we have here is it shows 63% of the time out of those 1,000 scenarios they ran, like you're good, you're not gonna run out of money. The other 37% shows that you would have to make adjustments so that way you don't run out of money. A lot of people see this as like 60%, 63% times you succeed, 37% you fail, but that's not really true. The other 37% just means you would have to make some changes. You'd either have to spend less, you'd have to retire later. Like there's options there. You would just have to adjust the plan to get that to a higher probability. At the age 33, this is great. I love this. If you were closer to retirement a year or two out, you want to see this probably closer to 75, 80%. But for now, this is great. We can make changes. We can get more accurate figures as we get closer. I mean, we're assuming a spending number of 23 years out that we have no clue if that's even going to match her lifestyle. And this is just showing like on average at the end, she'd die with $1.3 million in the bank. So this isn't showing that she needs $1.3 million to retire. That's a common misconception. And this is just assuming she retires at 65. She spends the same amount in retirement as she is spending now, and the savings goals that we discussed. All right, so taking you over to the tax analyzer, what I do want to show you is the savings that are being generated from the S Corp and how we generated that additional $1,000 a month for Alicia to be saving and investing. So if we take a look here, she's getting $250,000 in business profits. It's being taxed as a sole proprietor, which means that entire $250,000 is being hit with a 15.3 self-employment tax, 15.3% self-employment tax. So what I want to model out to you and show you here is we're going to pay her $75,000 as a reasonable salary for an S Corp. Now, this is an estimate. You'd want to talk with your tax professional CPA to make sure that this is a reasonable salary, because the one thing to understand about an S Corp is that you can save money on taxes. However, you're incentivized to pay yourself as little to no salary as possible. However, the IRS says you have to pay yourself a reasonable salary, or else when they audit you and they conclude that you're not paying yourself a reasonable salary, you'll owe back taxes, penalties, etc. So it's a really gray area because they don't tell you what a reasonable salary is. But the rule of thumb I like to consider is like, what would it take to hire someone to replace you? So for this example, let's use 75,000. This might be high or low based on, the actual scenario, but I think it's a decent comp. So if that's the case, then we're going to go 0 here and we're going to do 175,000 in this line 5 rental income, royalties, partnerships, etc. S Corp distributions are going to be included here. So let's take a look at this. And we're going to go over to details, and what you'll see here. So we go line by line, and what we want to come down to is here. So your total tax, look at this. Your total tax owed is actually higher with the S Corp, right? That's just based on some deductions, etc. The QBI deduction goes down a little bit. So it's like, oh, wait, I'm going to owe more. But then you have to add in the self-employment tax for this entire $250,000. It's a huge amount. It's almost $29,000. Now you'll see $0 here, which isn't actually accurate because this is unable to realize that like the 75,000, you're actually paying that. It's coming out of your paycheck because you're gonna have to set up payroll, but you're actually paying that as the company, so it's coming out of your pocket. So what I do is I add that back in, right? So we're gonna look at 15.3% of 75,000. Which will be about $11,500. So if you added that back here, that gets you to about $45,000. So you're actually only saving about, it says $14,000, but you have to add in some admin costs. So I would say about $12,000, which miraculously lines up with the additional $1,000 a month I have Alicia saving. So that shows you exactly how we were able to say, okay, you've told me you have X amount of cash flow, but can we find additional cash flow for you to save and invest? And an S Corp's a really good opportunity to do that. This is just one of the levers that we can pull to increase profit and cash flow and after-tax money that's available to a business owner so they can start saving and investing to build wealth. All right, if you want to watch a real case study where I look at a real client scenario and turn it into hypotheticals, but it's based off a real client, go ahead, check out this video next. And remember, if you want to schedule a call, you can find the description, the link below.